Welcome to the Spot On Insurance Podcast, brought to you by ILSA, Insurance Licensing Services of America. This is Ted Tavares.
And this is Arlene Tavares, coming to you from beautiful Puerto Rico. I'm so excited because today we'll be exploring the latest innovations and industry trends.
But before we begin, please remember to click on the subscribe button so you don't miss a single episode. And now, here's our host, Doug.
Hello and welcome to Spot On Insurance. This is your host, Doug Foresta. With me today is Dan Maher from Excess Line Association of New York, or ELANY. Dan, thank you so much for joining me today.
It's my pleasure, Doug, and it's good to speak with you again.
Thank you. And I know what we're going to talk about today. The topic is several new developments in surplus lines. We're going to talk about a couple of new developments, but maybe to begin with, we could talk about a new video that you released. And could you say a little bit for our listeners about what that video is?
Certainly. On the positive side, one of the newer releases from ELANY is an affidavit Part C, which is the affidavit that has to be completed by a retail producer who places or acquires surplus lines coverage through a wholesale broker. We've put an electronic version of that form on our website, and it eliminates a lot of the mistakes that brokers tend to make, that the retail brokers tend to make when they complete it by hand. So if they use the electronic version, many fewer mistakes will be made. So we did a video just to help the customer service representatives who usually complete those affidavits at the retailer's office to show them how to use the online affidavit. It's very simple, but if you're not familiar with it, you might hesitate to use it. So the video is intended to help the retail customer service rep learn how to use the form and hopefully encourage them to use the form.
Well, let's talk about growth in the E&S market. And, speaking about positive things, I know that there's been some growth in the E&S market. Can you say a little bit about that?
Sure. If you look at the numbers, and, we have a very robust statistical section on our website. We've been building over time, but it's really very granular at this point. But to look at the years, say, from 2013 through mid-year 2017, we've set records in terms of total transactions processed and in terms of total premium processed for the last 3 years, and we expect to break the record once again in 2017 if the numbers continue, because we're up about 8.5% July versus July last year in premium and up 10% in transactions. Last year, New York, the surplus lines market, had about a gross premium of about $3.7 billion. So it's a very substantial growth in our market over the years. And I should mention about $1 billion of that is construction risk alone. The construction boom in New York, and I say boom because the economy is up, but we not only have new high rises going up in Manhattan and in Long Island City, but you have a lot of infrastructure projects. You have projects such as the Tappan Zee Bridge, the new bridge, and the LaGuardia Airport projects. A lot of that risk for the construction work is placed in the New York excess line market. So, it's good times in that sense. We're always dealing with volatile risk and high-end exposures. But having said that, that's the market we're in. And right now, it's at the most substantial level it's ever been in the history of New York.
So is construction the main driver of growth in the E&S market? Are there other factors that are contributing to that growth?
I would tell you that other factors might be growing the transaction count, but the increases in premium volume almost tracks the construction risk premium volume increase. And you can actually find that in the stats sections of the ELANY website. If somebody wanted to look at it more granularly, they'd be able to tell that.
So that is all positive. I know at the same time, there's some increasing regulation that you're facing in New York. Can you say a little bit for our listeners about what that regulation is and what's going on?
Absolutely. And I should maybe, as a backdrop, mention that since 1998, ELANY has participated or been the primary sponsor of legislation that expanded classes of business or added new classes of business that can be written in the excess line market. And one of the exhibits I have in front of me suggests that all in, brokers were able to place $562 million of additional business in New York based on those expanded classes.
Wow.
Having said that, we continue to work to try to expand the classes of business, not based on anything else, but really to help insureds meet their needs. And, I'll mention what we've been working on legislatively the last year and a half, 2 years. Most states allow some level of insurance for punitive damages. New York does not. We see the desire to insure punitive damages, particularly in certain professional lines of business, such as directors and officers liability, because there are federal statutes, for instance, like Title VII, where if your employee is found to have, say, intentionally discriminated against a person based on the protected classes of Title VII, you can be hit with statutory punitive damages. So the shareholders and the management team of a major company, they don't want to have that exposure uninsured. Often they go to Bermuda and buy a punitive damage wrap, and they might do that as a direct procurement. But essentially, the New York brokers would be much happier in the main if they could incorporate that coverage in the D&O policy itself. So we've been working to pass legislation to permit, under certain circumstances, the insurability of punitive damages in the state of New York, to do so and be similar to other states in the country. We also have restrictions in the New York market on writing primary medical malpractice insurance for doctors, dentists, and general hospitals. We do write excess and certain other subclasses of medical malpractice, but the New York marketplace for medical malpractice is in crisis as far as I'm concerned, and I think I could point to data, which I won't for the sake of brevity, but we would like to expand and allow these insureds, these doctors and hospitals, to have more options. They don't have to buy insurance in the excess line market if they don't want to, but they might find that for security purposes and for expanded levels of coverage for evolving risks such as telephone and robotic, remote robotic surgeries and things like that, our products might be more robust than they might find in the admitted market, as just two examples of why we would choose to try to pursue those new classes of business. So while we're working to expand the excess line market, and we did have some success earlier this year, New York, there was, if you will, at least I would call it a battle to try to prevent the excess line market from being able to insure TNCs, transportation network companies such as Uber and Lyft. And the industry, stepped up to the plate, and the governor's office signed a bill that does permit the excess line market to insure such risks when the admitted market is not available. And that was a big positive. Having said that, the New York regulatory scheme has grown more restricted in recent years, and the regulators promulgated an emergency regulation to implement the transportation network company legislation. And it was, I have to say, very anti-excess lines. Maybe that was intentional. Maybe it was not. We've had meetings and we've written to the Department of Financial Services, and we've encouraged them to take another look at those regs. And we hope that some of the onerous provisions will be rolled back. But that's a wait and see. We don't know that. But we've seen some other things at the Department of Financial Services which are very restrictive. They've passed a regulation number 209 in the last 12 months, and that restricts in a commercial crime policy an exclusion that has been standard for years. Typical exclusion in that policy would say, we will pay for losses due to theft by an employee, except an employee who has a prior criminal record. that is no longer a permissible exclusion based on a change made by the regulators. So that was drastic, and if in reading the reg, you would probably have at least half the people who would read it say that probably applies to the excess line market too. We're not a big market for commercial crime coverage, so it may not have a big impact, but it does have a precedential value and concern. We don't want to see the excess line market's hands being tied to address the needs of insureds. So then you have a third issue with, and this is purely an admitted market issue, but there's a proposal to restrict the use of education and occupation as rating factors in personal auto policies. So once again, we're seeing these restrictions, and that's has to be very concerning to the marketplace.
Spot on Insurance is sponsored by ILSA, Insurance Licensing Services of America, America's premier insurance licensing experts. To learn more about ILSA and the services they provide, visit ilsainc.com. So, Dan, these new restrictions, could they potentially impact license reciprocity with other states?
I don't think so. I see this as, more of an insurance company issue than a producer issue. And it's really designed to impact personal auto coverage for vehicles that are registered in New York or where the owners of the vehicles are New York residents or both.
Thank you for that. And I want to discuss something that I know you said is becoming a trend in other states, which is repealing the diligent effort requirement in whole or at least for commercial lines. Can you discuss that and the potential impact that could have?
I'd be happy to, and thanks. It's a good question. Yeah, I've started to notice, and I'm sure others have too, that it's been a trend, not a strong, but I would call it a light trend, but the fifth state in the country this year repealed their diligent effort. That was the state of Mississippi. Among other states that have repealed, Virginia has totally repealed their diligent effort. They were first, I think. Louisiana and Florida have repealed it with respect to commercial risk. And then I believe Maine, I think it's Maine that is the fifth state. And it's an interesting, situation because, I think that regulators, and particularly in New York, get suspicious that the non-admitted market, the excess and surplus lines market, would compete head-to-head with the surplus lines market if it could, and that the diligent search is one of the reasons that there is no or helps prevent head-to-head competition. But the reality is that the retail broker in any transaction of the kind that come into the surplus lines market controls whether the risk goes into the excess line market. Most of the New York risk, 2/3, are placed through wholesale brokers, and that tells you that retail broker has no market that's viable for that risk, and that's why they're going to the wholesale broker in the first place. So a retail broker is going to a wholesaler. He's splitting commissions. He's, instead of dealing with his preferred markets and markets where he knows the policy language well, he's going to a wholesaler, to a market he doesn't know, to underwriters he doesn't know, where the policy language is not familiar, where he has extra regulatory requirements with regard to an affidavit, and where there's no guarantee fund. So all those things combined makes for retailers saying, I'm only going to go to the wholesaler. I don't go to the wholesaler because I love paying them half of my commission. I go there when my insured needs me to go there for the best result I can get that insured. And, our stats say only about 15% of all retailers go through wholesalers. In other words, out of all the licensees in New York, over 40 some odd thousand, only about 15% or 7,000 ever utilize the excess line market through a wholesaler. So we have very good statistical evidence that says, the diligent effort is not what determines whether or not a risk goes to the surplus lines market. It's the needs of the insured, and if you will, the guardian at the gate is the retailer. He'll make the determination as to what the best market for the risk is.
Have you heard of any feedback from the states that have repealed diligent effort and what that's looked like?
Very good question. I was talking to a deputy commissioner from Virginia the other day. He happened to be at the NAIC meeting, and I've known him for years. And I said, tell me something. have you seen any changes in your surplus lines market at all as a result of your repeal? And, he said, none at all. And, I want to try to get a better stat result so that I can start to track those results. Because I think ultimately, whether we're successful in New York or not, I want to try to repeal the diligent effort, at least with respect to wholesale transactions. If the retailer is only going to the wholesaler when he has to, then the paperwork we're doing, establishing what admitted companies did not choose to write the risk, it's a lot of work. And, we're in a very fast-moving market. And that extra work is expensive and, it's not, in my opinion, accomplishing much. And it's certainly not accomplishing when weighed against the amount of time, effort, efficiency, and what those employees of a brokerage could be doing in terms of servicing their client as opposed to filling out this paperwork. On scales, the diligent effort doesn't bring a lot to the table.
Well, as we get ready to wrap up here, I'd like to ask you about classes. If there are any other classes that you plan to pursue in the future?
That is a very good question. We are seeing, what you hear as emerging risk. Coming into the excess line market. So what are we talking about? Well, we created a standalone cybersecurity or cyber liability code. So if it's a standalone cyber policy, we code that separately, and we've seen some substantial growth in that class of business in the last year or two. Last year, for the full year of 2016, it was about a $40 million market, which is not that huge, and 3,600 accounts. This year through June, it looks like it's going to be on pace to be 28% higher. It looks like it'll be a $58 million market with about 5,000 transactions. So there's growth in that standalone cyber liability space. But we've also talked to a lot of tech companies that are trying to sell, putting aside the T&C market, that are looking at drone liability coverage, that are looking at selling, essentially coverage that matches the short-term rentals in an Airbnb type situation. So we're seeing, people trying to match coverage to the short-term needs of insureds, and that's not, New York law does not really set up for that. So we're going to see what happens over time as our regulators come to grips with these short-term coverages that are trying to be sold over the internet, and how is that going to be done if it's a non-admitted product? Right now, the laws are, they're, if you will, out of date to handle these kind of emerging risks. So that's going to be a challenge for the whole marketplace as we move forward.
My guest today has been Dan Maher from Excess Line Association of New York. Dan, if people want to learn more about ELANY, what's the best way for them to do that?
Great question. Thank you. One, our website is probably, we're pretty proud of our website. We think it's probably the best excess and surplus lines website in the country, not to overstate it.
But it is, right?
We think it's, for the excess and surplus lines geek, it's the right place to go. The lawyers love it, by the way. And then we've recently established an ELANY page on LinkedIn. So please, sign up for our LinkedIn page and follow us on LinkedIn.
Dan Maher, thank you so much for joining me today and for sharing such important information.
Thank you, Doug. It's been a pleasure.
Thank you.
By the way, our show notes and bonus resources can be found on spotoninsurance.com. Subscribe now so you don't miss a single episode.
Thanks for joining us.